For the last 30 years or so, we have been in a period of global neoliberalism in which financialization, a term I'll define in just a moment, has been the dominant motif, as opposed to the previous social structure of accumulation of the immediate post-war period of national Keynesianism. And perhaps a word or two on this distinction is useful, because if Obama is elected, and Michael assures me he will be, that
take that home and put it in the bank?
Absolutely, but I'd be careful which bank you put it in. That we may move into a new stage. Now, the two stages that I want to briefly describe: national Keynesianism is a regulatory period of capitalist development in which the nation state, using Keynesian policies, stabilized and regulated capitalism to a significant extent. And it was a period of rapid growth, which broke down when we entered stagflation in the Vietnam War years, late 60s, early 70s. Nixon took us off Bretton Woods and the fixed exchange rate, and we moved to an era in which globalization has become the key word, in which corporations more explicitly than in the past maximize their profits on a global scale, and which the nation state has less sway over capital. This is by preference, not by accident. The magic of the marketplace, which came in with Thatcher and Reagan, sets the context in which what has happened in the American economy has happened. Now, financialization is a term which refers to the increasing importance of financial markets, financial motives, financial institutions, and financial elites in the operation of the economy and its governing institutions, both at the national and international level. Financialization is thus an umbrella term for this penetration of finance into all aspects of the economy, manifest in everything from the growth of student loans rather than scholarships, to greater use of credit cards, to home mortgages and the subprime crisis, which is more of immediate concern. Finance capital, footloose and flexible, interposes itself wherever arbitrage opportunities present themselves. Hence, we get the carry trade, where people borrow in Japan, where interest rates are very low, invest it where interest rates are very high, and then pay back your yen and make a lot of money. Where leverage, the use of borrowed money to make money, becomes the dominant way to get ahead. Financialization is also the policy choice of governments in alliance with internationally oriented financial institutions like the International Monetary Fund and similar organizations. It is a tool of accumulation pushed powerfully by the American state and other money-centered governments. If you take a world systems perspective, you can look at the parallel between the other great hegemonic powers, the Netherlands, Great Britain, each of them, as their period in the sun was declining, became the dominant financial power, which extended the success of national capital for a century or two after their place as productive capital, as trading nations, as colonial powers declined. And the U.S. followed along in this, but into a period where debt drove the economy to a much greater extent. Consider the gross liabilities of the United States financial sector in 1980 were equivalent to about 21% of our gross domestic product, the goods and services we produce each year. So the financial sector was about 21% of the total output. In 1980, in 2007, it was 116% of gross domestic product, and financial firms were gaining, or were earning is a rough term to use, but they were earning 40%, 40% of all the profits of all the corporations in America, up from single and low double digit in 1980. So financial firms have just metastasized in terms of their influence. The deep crisis which we are now in, and it is a deep and will be a prolonged crisis, begins in 2007 when the subprime bubble breaks, but its origin is earlier. It's in the way we solved the last bubble, the internet new economy bubble, in which the dot-coms were going to make all of this huge amount of money, and the stock market went up in the 90s, second half of the 90s, and then collapsed in 2000, 2001. And to get the economy going again, the Federal Reserve System lowered interest rates dramatically and left interest rates very low for a number of years, setting the stage for the housing bubble, which then proceeded. Because the cost of buying a house is one question, but for most people it is the monthly payment. It's the monthly mortgage payment that you care about. And with low interest rates, that meant low monthly payments. And housing prices shot up so that people sold homes, bought bigger homes, speculated. People who'd never had a home were encouraged to buy one with little or no money down. So-called ninja loans became popular. Ninja is a technical term, not in martial arts, but in mortgage broking. No income, no job, or assets, ninja. People who had no job, no income, or assets were encouraged to take out a mortgage, because the mortgage originator got a bonus when the mortgage was signed, and that's really all they cared about. Then, in this era of financialization, mortgages were bundled up and securitized. That is, a big bunch of $10 million worth of mortgages were packaged up and sold as collateralized debt obligations to someone else, maybe in Abu Dhabi, maybe a pension fund here, maybe an insurance company. And the mortgage originator continued to process the mortgage, but did not own it. The mortgage was owned by someone else, or a very large number of people, because these mortgages were broken up into pieces, packaged, sliced and diced differently, according, in theory, to the riskiness of the mortgage, so that the subprime mortgages, more risky than others, were in one pile, and the worst of those, the toxic waste, were in the bottom pile, but they paid the highest interest if you collected on it. And since there had not been any defaults on these mortgages for a number of years, from 2001 to 2006, the housing market, as you know, only goes up. Housing prices cannot possibly decline, and so nobody was They can decline? They have declined by 20%? They're going to decline by another 10%? Now that could cause a problem, as we know indeed it did, because the mortgages were sold on in these very complicated debt instruments, and it wasn't clear who was holding what. That they were rated by Standard & Poor's and Moody's. They had very high AAA ratings because there had been no defaults for the 4 years of their existence. I should also say Moody's and Standard & Poor's is paid by the banks that sell these assets, and if you were to rate them more harshly, you would lose the business of rating them. Someone else would give them AAA ratings, so you might as well do it and make the money. So you have this kind of system going where mortgages were easily given and easily sold on, and then you could insure yourself against loss, and you could buy insurance on your collateralized debt obligations. So in case it didn't work out the way you hoped it would, you would be reimbursed for your trouble by paying a small insurance premium. It was a no-lose kind of thing, and so trillions of dollars of these were sold all around the world. In addition to this is a global framing, which is important, because while the discussion up to maybe 2 weeks ago was about our crisis, the crisis is actually far worse in many other countries in the world, not just in Europe, but all over the place, from Algeria to Azerbaijan, Brazil to Beirut. Everybody is in trouble, and we need to know why that is. The United States, and I'm reading Martin Wolf's book, which came out in 2008, but he finished in 2007. And so for him, the problem is the dollar is going down. And up to a short while ago, the dollar was going down very dramatically. The dollar has been going up incredibly. And everybody, well, what's that about? Well, the international dimension gets very complicated because we're in less trouble than other people, as much trouble as we're in. And people are fleeing to the safety of Treasury securities, Treasury bonds, Treasury bills, which pay just about nothing at this point, but at least you're not losing money as you would in many other places you could put your money. So we have this larger context. We also have a larger context of stagnant or declining incomes for American workers, which is a very important piece of this, as members of this seminar are very aware. Since 1973, with some ups and downs, average wages for non-supervisory production workers have risen very little, if at all, even though productivity has soared and profit shares to GDP have grown immensely, and the wealth concentration at the top, to an extent not seen since 1929. People always say 1929 as if it has some significance.
When I was born.
Explains it. All right.
Window jumping.
Yeah. Okay, so from 1990 to 2002, in the bottom 90% of the U.S. income distribution, each taxpayer no, we don't want to do that. I want to. My man John McCain has explained it better, and I really don't want to explain why we need to extend the tax cut so that the upper 0.1%, about 14,000 individuals, can continue to get an extra $18,000 a year, while the rest of us pay higher taxes. He explains it better than I do, and I haven't quite been able to. Yeah.
Spreading it around.
Okay, so the data, the IRS data shows that most was received by this top 10% of the income distribution. Within that, the top 1/10 of 1% are the only people who got a tax cut out of this, which I find disappointing because my man.
For Bush.
I voted for Bush twice. Yeah, I thought I was going to get something. Yeah. Okay.
Son of a bitch.
Yeah. Well, I figured the only way I could get an increase would be through a tax cut. But let me skip all of that and go back to the market. Okay. So if the subprime defaults were all that was at issue, we would not have a very serious problem. That when all of this became a crisis and Bear Stearns funds started collapsing, and then Bear Stearns collapsed and so on, there were only about 3% of the mortgages that were in default, which we could have handled. It wasn't that much. It was the collateralized debt obligations that were the problem, and it was especially the credit default swaps. Now, the credit default swaps are very important in this story. They are the insurance policy that, and you can buy credit default swaps against the possibility that a corporate bond, like a General Motors bond, might default, or that an aircraft might not be sold. You buy credit default swaps on anything. They're a way to bet to gamble that something is going to happen. Now, they are not called insurance, although that they were sold as insurance against an event happening. The reason they're not called insurance and instead called swaps are that swaps are not regulated. Insurance companies are tightly regulated. That if they were sold as insurance, you would have to keep capital in reserve in case you had to pay off on the insurance. That's how insurance is supposed to work. But by calling them credit default swaps, this is a market that is totally unregulated. There is no capital required against this. And even at one time, the world's largest insurance company, AIG, which sells life insurance and home insurance, it insures my private jet. You know, they do a lot of stuff. They have an office in London, has about 370 people, who started selling these credit default swaps to anybody who wanted them for anything. And they sold them because they figured they'd never have to pay off on any of them. And so the collateralized debt obligations, which were bonds sold, packages of mortgages, but also packages of credit card receivables. Let me take a minute on this because Jerry's looking at me funny, and if he is, then what he always does, so it may not be any. Yeah. Let's say you're Macy's, and you expect to get $10 million in credit card payments over the next year. People have Macy's credit cards, and they're going to be paying them. You sell those credit card receivables, and you get not the $10 million you would have gotten, but say $9 million. And you use that to buy the fall season stuff. You raise cash by selling your future source of income. Or if you're New York City, you sell TANs, tax anticipation notes. This is a way the city gets money now, and when people pay their property tax in January or wherever it is, that money will then go to the people who gave the city the money when they bought the TANs, the tax anticipation notes, bought them in anticipation of the tax. Now, these sorts of financial instruments have become very popular. Car loans are sold, credit card receivables are sold. It's hard to think of anything that can't, any flow of income that can't be turned into one of these instruments sold to somebody for cash immediately. And it works pretty well as long as the city collects the tax, Macy's credit card people pay off their credit cards, and they always leave a little slack. But if there's a big problem, and the city, let's say, Wall Street collapsed or some ridiculous thing like that, the city might not actually get all of that tax revenue, and then they would default on those tax anticipation notes, or on the credit card receivables, or on the subprime mortgages, or on all of them. So that in an unexpected event, it could be bad. And the people who sell the insurance, these credit default swaps, and there are something like $60 trillion of credit default swaps out there. It could create trillion. Yeah, the numbers in this stuff are unreal. We're not sure it's 60 trillion at all. That's an estimate, maybe even a guesstimate, because it's a totally unregulated financial instrument. They don't report to the Fed, they don't report to the Treasury, they don't report to anybody. And they do have an association, and they give this figure, but who really knows? Okay, so the investment banks, Bear Stearns, Lehman Brothers, names that have become more familiar in recent weeks, were very involved in this. They were packaging the collateralized debt obligations. They were selling insurance on them. They had set up SIVs, S-I-V, special investment vehicles, and the special investment vehicles set up by a bank, investment bank or commercial bank, was set up to buy the collateralized debt obligations. So the bank packages them, sells it to an entity that's not itself, but which it sets up, provides them with a backup line of credit in case anything goes wrong. They come back onto the bank's books, but they are not on their balance sheets. And so there's no capital kept against them. All of the regulations that the banks are subject to, the civs are not. That's, of course, why they're set up. There are tax advantages, regulatory advantages. Sorry, yeah?
If they increase earnings and increase stock prices.
Exactly so. And that's the idea. This is part of what is called the shadow financial system. And as Halloween comes around, it's very scary. Because the shadow financial system includes the hedge funds, the civs, the private equity groups. The private equity groups are interesting. These are the people who bought Chrysler. They did it with borrowed money. They then used the assets of Chrysler as collateral on the debt. So Chrysler is now in this huge debt just in time to collapse, right? They have bought up thousands of companies, most of which you haven't heard of. They squeeze the workers, force them to make concessions, whether it's an airline or whether it's a steel company. They squeeze the suppliers. They cut the health plan. They cut the retirement benefits. They have to pay interest on the debt because they bought it with borrowed money, and they have to pay interest on it. They sell off its assets, declare a very large dividend to the new owners, and after they've gotten as much out of it, they sell it off again, the whole thing hopefully earning them enough money to have the New York Public Library named after them. Well, these are very civic-minded people. Yeah. Okay, so you have a number of shadow financial institutions which have grown enormously and have changed the way the real economy, corporations in the case of the buyout groups, operate. Because if you don't want to be taken over by one of these guys, it does not pay to have a lot of excess cash on your balance sheets because they go after cash cows. They're looking for companies that actually have a lot of money in the bank. They buy them by paying higher than their stock is selling for, and then they raid all that money. So if you don't want them taking you over, destroying you, taking all the money, you have to pay the money out yourself. You buy back your own stock, raise the price of your stock so that it's harder for someone to buy you. In effect, become more insecure, more on the edge, more close to bankruptcy, because then it's not worth it for them to do it. Of course, it's not good for you either, you, your workers, or anybody else. So they've changed the nature of corporate finance. They've changed the nature by using leverage of the stock market. And because of all these ways to gamble on what may happen, they've created a huge shadow financial system that's much bigger, vastly bigger than the real economy, which is insignificant. And the reason the investment banks have to use leverage is what they're doing is they're making actually very little money on equity. Equity is the amount of capital they themselves have. So what they do is they borrow 20, 30 times as much money. And so if you make a little bit on the 30 times, as a proportion of the actual money you have, you've made a bundle, even after you pay interest for the borrowed money. Now this works as long as it's going up, and as long as your bets work. When they stop working, the leverage goes in the opposite direction. So the hedge funds, which we're now hearing about, are holding 30, 40 times the assets of the actual money they have. But they're doing it with borrowed money. And as the value of these assets go down, people who have lent the money say, hey, we want our money back. So they have to dump the stock on the market to raise what they can. And when they do that, the stock goes down. And so when panic sets in, we have what we've had in recent weeks on Wall Street, magnified immensely by the requirements of this high leverage and these players, and firms collapsing, as Bear Stearns and Lehman Brothers, in fact, did. Okay, so last year, 2 years ago, 2006, Wall Street sold $500 billion in collateralized debt obligations, bonds backed heavily by the subprime mortgages. $500 billion. Now, that's not the worst of it. We've talked about the larger thing. And liquidity is closeness to cash. And if you think about what a bank does, just a simple, ordinary, the kind of bank we all think we know about. What a bank does is it takes your deposits, they're there in your checking account, in your savings account, which you can take out anytime you want. They use the money to make longer-term loans to businesses for 10 years, 10 months, to homeowners for 20 years, 30 years. That is, their liabilities are short-term. You can take them out anytime you want. Their assets are long-term. It's money that they're lending. It's going to come in over time. That's why there are runs on banks. Historically, throughout American history, every 5 years or so, there are these mammoth runs, until in the Depression, they set up the Federal Deposit Insurance Corporation, and you don't have to worry if your bank collapses. Wachovia, Washington Mutual, all these banks that were advertising heavily on TV, they're gone. But it doesn't matter. The name changes to Wells Fargo or Bank of America or something. Your account is fine. You get new checks with the name of the new bank. Nothing. Because the FDIC is there, and up to, used to be a couple of weeks ago, $100,000. And I'm so relieved because, keeping the amount I have in the bank. But what did they raise it to?
250.
Well, that won't quite cover my petty cash, but it's close enough.
Who keeps that kind of money? That's what I'm going.
Yeah, one of big businesses do, because they're constantly having to pay large amounts for things, and when the steel company needs coal, they don't send a bunch of guys with suitcases and $100 bills down. They do an electronic transfer through the banking system, and also small businesses and church groups. That John, I don't know if you remember when. What was the bank in Harlem that a lot of the churches had their money in? Carver collapsed, and a lot of those churches lost a lot of money because they had over the $100,000, their church funds and so on, and they lost it because Carver was too little to be saved. At that point, the big banks were saved because they were systematically important. The little banks weren't, and so people learned their lesson. They don't go to little banks anymore. They put it in big banks because. Yeah. Okay, so this gets us to Henry Paulson. What to do about this? Now, yes, it is true that Henry Paulson came from Goldman Sachs, but there's nothing unique in that. Robert Rubin came from Goldman Sachs. Right. I mean, Wall Street provides secretaries of Treasury, and I do think it's right that Goldman Sachs has the smartest guys on Wall Street, and they do tend to have this public service mentality. Now, there are those who suggest that Lehman Brothers was not saved because Goldman Sachs didn't have any money there, but they were the largest. No, they were the largest counterparty for Bear Stearns, and so if Bear Stearns, had not worked out the deal to be taken over, Goldman would have had some difficulties. Although Goldman denies that, and I know them to be honest people, so I'm sure it's true. Anyway, after about a year of doing nothing and temporizing and explaining the magic of the market, Paulson wrote a very complicated financial plan, which my man John McCain went to Washington to get Congress together to pass this plan. Now, it is true he hadn't read it, but that's not John McCain's fault. It was a very long plan. It was 2.5 pages long. And what the 2.5 pages basically said, as I think some of you know, is that you, the taxpayer, will give me, Hank Paulson, $700 billion without any oversight by anyone. nor any possible review by any court in the United States or anywhere else. Now, Congress didn't accept that. Even though the world was about to collapse, they thought it was socialist. And of course, it was socialist. It is the socialism for the rich that we have in this country, and whenever there's a crisis, comes out. So it instead got to be a much longer plan. And in Paulson, when he went to before Congress, he said it was to buy the most toxic assets, the worst of these collateralized debt obligations, which he said would somehow make the situation better. Now, I don't know of any economist anywhere who thought that was correct. That you got from conservative, liberal, Marxist, free market, everybody. How is that going to help? You got trillions of dollars of these. You're going to throw $700 billion. They're going to say thank you. But they're not going to lend any money out of that. And besides, you're going to overpay like crazy. So Paulson said, of course we're going to overpay. If we gave what the market was worth, it wouldn't help them. We have to overpay. Well, that didn't go very well. So the next day, Bernanke said, no, he's not going to overpay because taxpayers objected to $700 billion of their dollars used to the worst offenders who sold the worst garbage, who created the worst of the problems. So about then, I keep wanting to call him Tony Blair, but he's not. Gordon Brown, who, like Tony Blair, for a year said, I am not old labor, I am not nationalizing banks, I am not nationalizing banks, we don't do that. Had a very first major bank collapse in a couple of centuries and nationalized a rocky bank in the north of the country. And then proceeded to nationalize a good chunk of the banking system, which is sitting on the same kind of assets that the American banks are, buying them like fools and investing and selling them on, but holding a lot of them. So what Gordon Brown did was he nationalized the bank with conditions. And the conditions are important because we have seen in the last, week, 10 days, this stuff moves so fast it's hard to remember, Paulson has nationalized banks. That is, he has taken shares in the large banks and thrown money at them, $250 billion. But what happened in England was they put conditions on it. This money that we're buying stock, we're giving you capital, on the condition you lend it to the real economy where businesses needed to make payroll, investors needed to expand the economy, and so on. Paulson said, no, this is not punitive. We are not telling them what to do. So in America, they could, if they wanted, pay it all out in dividends to their stockholders. In England, they couldn't. It could not be used as the stockholders took a bath. They didn't get rewarded. Sweden went through this. They very foolishly liberalized their financial system, had a real estate bubble, the same kind we did, collapsed, and the government just took over all the banks, reorganized them, nationalized them, created order, sold them back to anyone who wanted to buy them, and the taxpayers in Sweden cost them nothing. They saved the system, the banks are back, but of course it's a socialist country, I have to tell you, or a social democratic country, not a real socialist country. But that's the only thing that works. Historically, and we've had something like 97 of these crises in different parts of the world over the last 20, 30 years. Our country historically has had the only thing, or the thing that works best is you nationalize them early before they can get the money out, and then you reorganize them, have them loaned to the real economy, cut off the stockholders because the bank failed, why should they get anything, fire and take away the bonuses that they got under false pretenses, and reorganize it. And then, since we believe in capitalism, we of course sell it back to private investors. And that is how financial crises are solved. Mr. Paulson won't do that. He is not going to tell the banks what to do because he believes in free enterprise. And that is going to prolong this thing and make it vastly more costly, the same way the savings and loan crisis went on if they'd solved it when it erupted, it would cost 20 billion, ends up costing 140 billion, because of course we don't do it that way in this country. We only do it absolutely the last possible thing when nothing else can conceivably work. Okay, now this has had an effect on the rest of us, because while Mr. Paulson's being very nice to Wall Street, the markets think he's nuts. And so his solutions have spread panic widely, and nobody trusts the government, the markets, the banks, or anybody else in here. Now, this means household indebtedness, which already is at record rates, government deficits, all of this stuff will mushroom. That when I was talking about debt, household indebtedness rose from 50% of GDP in 1980 to 100% of GDP last year, 2007. The American consumer just can't borrow anymore. And they, of course, can't declare bankruptcy anymore because the credit card companies got the government to change the bankruptcy laws, so that it is very hard now for the consumer who's cutting back with unemployment rising. The consumers can't get you out of this. They've been valiantly spending far more than they earned, going deeper in debt to get us the growth we've had. This cannot go on. Banks have stopped lending to small and medium-sized businesses, and businesses are now using credit cards and paying the high interest charges, which the banks raise on them as soon as they get a big enough balance to make it worth their effort. So we get this gloom and doom sort of situation. Let me talk about that, and I don't know that I know any more than anybody else in this room or anybody else in America what's going to happen, but I suspect we're looking at a much deeper, much more prolonged recession, come depression, than anything we've had since the 30s. That none of the downturns begin to hold a candle to this, because you didn't have the same kind of debt. You didn't have the same kind of leverage. You didn't have this financialization which puts you in this situation with all of that obligation out there and the need to shrink the financial sector back to something approaching what it used to be, where its function was to give mortgages to people who qualify for mortgages and who hold the mortgages, or at least some part of them, so that they do due diligence and see that the people can really pay the mortgage and so on. You're going to have to move back to a regulated, that whole shadow financial system has got to be regulated, and as soon as you regulate it, it won't exist anymore, because it can only exist without regulation. With regulation, it couldn't. So that's an incredible, incredible change from the whole social structure of accumulation of these past 30 years. As it's gotten bigger and bigger, it's got to disappear. And that's going to be very, very painful. And it's going to affect the rest of the economy. Unemployment will rise, and so on. Well, the stock market has dropped 44% in the last year. The story in the Times by Michael Greenbaum, that most of you saw, going for the gold in gloom and doom. That is this going to be the worst downturn since 1929? How bad is it going to be, right? Is it going to be the worst? Well, maybe, maybe not. Last Thursday, a few days ago in London, Nouriel Roubini, who's been the most Dr. Doom, as he's called, because he forecasted, he said it was going to be bad. Thursday, he was making the point that markets were in sheer panic and becoming literally dysfunctional and unhinged, that they're in free fall as investors rapidly deleverage, and his optimistic suggestion was that stock prices will have to fall another 30%. Well, I don't know, but in the depth of this is very real, and it has to for the reasons I've explained. It also has spread around the world. The German finance minister who said this is an American problem, Deutsche Bank doesn't do things like this, right? Biggest joke. The Swiss are now bailing out their banks, and everybody has to, because they've all learned American finance and are practicing it. But it also affects everybody else, from Seoul to Sao Paulo, from Hungary, the Ukraine, Latvia, Lithuania, I mean this list. And not all for the same reason. That some of these countries are commodity producers, and when economic activity slows, the demand for commodities slows. I mean, one of the bright spots is oil prices fell dramatically. Not that we've seen it at the gas station much yet, but it's beginning to go down. And the commodity prices go down because economic activity slows, and so the demand for copper and magnesium and all the rest of it goes down. And the countries that export these things now are having difficulties because the prices have dropped, their income, their major export crops have dropped. Other countries borrowed very heavily in foreign currencies. And now they have no foreign direct investment coming in because that money has been brought back to the countries where they need to cover other obligations. The banks in those countries and the corporations in those countries that borrowed in foreign currencies can't pay back because their own currency is going down in value, and the dollar is going up in value. So it makes it almost impossible for them to keep paying off the debt, which the banks now want the cash back. So you're seeing very serious difficulties from Thailand once again, Brazil, Argentina, and sale of consumer electronics falling as American and other consumers put off. There's no more of this using your house as the ATM machine to buy a big flat screen TV for Christmas this year. Forget it. In Europe, one of the most interesting things in Friday's paper was Volvo trucks. The demand for Volvo trucks fell 97.3%, or 99.7, it's somewhere in my notes. Basically, they had orders for 130 trucks. Yeah, it plunged 99.7% in the last 3 months. Well, round off 99.7%? No, they sold. They sold something like 130 trucks. They had orders for 130 trucks in Europe, in the world. So Volvo will be laying off workers in the truck plant, as are auto producers, and they're all lined up. Detroit has promised 25 million. Obama raised it to 50 million when he was in Michigan campaigning. Some coincidence there. The insurance companies are lining up because they're in trouble. The airlines are. So you have all of this stuff. I looked for some good news, and there is one bright spot in the financial market. That is Zimbabwe. The Zimbabwe Industrial Index gained 249.90% last Friday, and has been rising.
And who's betting on Zimbabwe?
The reason. No. See, you people are such cynics. You probably might know that the inflation rate in Zimbabwe is, and I kid you not, 11 million%. People are refusing to carry around sacks of money anymore, and basically the economy's turned into a barter economy. So the only place you can spend your money, it turns out, is the stock exchange. So everybody is bringing these piles of money in and buying stock because nobody else will take their money, and that accounts for this 249.9% rise in the stock market. But with that good news, that's where we are, and that's why we are where we are. I'm going to stop to take questions on what I've said, and then lead us partake in a discussion of how we see moving forward. But let me stop there and take questions. That's another theory. I personally think what it was, Paulson could see them all lining up. And since for months everybody knew Lehman Brothers was in trouble, its stock was down very far because the market understood this. I think he figured, I will tell these other guys, you're not going to get bailed out. You have got to cope with it. Sell yourself to a bigger bank. Solve it yourself. I'm not going to throw money at you. That's what I would have done. But of course, by doing it, he basically created such panic, because when Lehman Brothers went under, the money market funds, which lent their money to Lehman, lost it. And so for the first time, the largest money market fund broke the buck as we say. That is, for every dollar you had in the money market fund, it was worth 96 cents. And people panicked about their money market accounts and started pulling their money out of the money market to put it in a bank where it was FDIC insured. So then Paulson had to insure all the money in all the money market accounts. So he's had to go further and further because at each step it leads to ramifications that are not necessarily foreseen in the deal. So the subprime stuff is the trigger. It's the trigger for the collapse. It's the immediate cause. But the buildup of credit, which I thought I had described, is much more long-standing and is huge and takes place within the context of stagnant incomes, which force the borrowing of people to maintain their standard of living. They can't keep up, but it's complicated because it's now global. It's now global. And so what they're doing is they're importing fairly cheap stuff from China and other places, so you're not getting any inflation, so you're getting low interest rates, which makes it possible to keep the borrowing going much longer and much larger, so that unlike other cycles that we get periodically, this one is much bigger. It's much bigger because the overextension and the debt and the leverage is so much greater. But it's based on the imbalance between consumption and production within this country, which adds the international debt.
If the credit is necessary, there's no way that regulating can solve the problem.
No, it won't solve the problem, but the reason this one is so much worse is because of the shadow financial system and the deregulation. You'd still have a downturn, and it's hard to tell how deep that would be, but you did have growth, and you do have growth in much of the rest of the world, and the United States would have a decline, but I don't think it would have been anything like what it's going to be. I don't know if that reconciles it.
Jerry, next.
Yeah.
I think Lenin does not work in the sense that the U.S. is importing capital. We've imported 80% of all the surplus capital that's out there. The United States keeps going on borrowed money. It's not that America is exporting capital. We're the world's largest importer of capital.
But capitalists, finance capitalists are exporting. Look, I mean, emerging markets, the Euro market, South America, there's a lot of American capital going there. It's true, a lot of it came back in terms of treasuries because of the balance of payments.
Yeah, but Jerry, it's very complicated because more capital comes in than goes out. And what what the American financial system is doing is it is laundering, or it is intermediating capital flows from all over the world. They come in, and some part of that goes out again to transnational loans and investments and so on. But it's not, I don't think, the mechanism the same way Hilferding and Lenin described it. But you made another...
The point of its impact on...
Yes, very important. Yeah, very important. That I would... It's always a question of where to start. That perhaps in terms of your question, the better place to start is the 1970s and deindustrialization, where industrial America, auto, steel, rubber, all the basic, heavily unionized industries, basically machine tools, everything, the productive industrial capacity of America is decimated to a very large extent. And we start importing all of those things. Now, there are still, and that happened for two reasons. One is increased productivity. That if you visit a steel mill today, you stand at the top and you look down 3 football fields and the heat is just incredible, and you see these 2 guys dressed like spacemen down there doing something. Well, if you'd visited a steel mill 30 years earlier, a lot of people working. You visit an auto plant, same kind of thing. It's amazing what the robots do, the painting, the metal bending. So it's not just jobs went abroad, but productivity increases were extreme. The other thing that happened is the industrial labor force in America now, we still have, and Michael probably has the numbers, we still have a large number of workers, not as many as real estate brokers, but still a large number of industrial workers, they are third world workers. There are more the chicken factories, just most of the small plants, non-unionized plants, and so on, competing with third world, and that's not where the money's being made. Those are small enterprises and so on. So industry is not the leading sector. You're not going to go back to it being the leading sector in the United States. You're going to have to move forward to a different model of accumulation. You are not going to be able to rebuild a lot of that. You may be able to rebuild new industries. People talk about energy and alternative energy as being a leading sector, which can contribute a lot of jobs and can be important. There are a lot of jobs in rebuilding infrastructure. But what all of these things require is government leadership, government subsidy, government action to do this. You also have all sorts of basic needs to be met in this country. Now, the question for us, and this is what I want to have the discussion on, I don't think you can go back to a simple Keynesian thing, because the balance of payments will swamp you right away. Give people money, they'll import even more stuff, because the video games and everything, the cell phones, computers, you name it, it all comes from somewhere else. You have to have an expansion based on creating domestic jobs for people that are labor intensive because they're service and so on. Yeah.
The last point.
It is the labor force, basically the global labor force, doubling in the last 20 years with the demise of the Soviet Union, China entering. And when you double the size of the labor force, you reduce the bargaining power of labor, and you reduce wages. You also bring an increase in the productive capacity to produce goods and services that vastly exceeds the capacity to absorb those goods and services. And so you see plants shutting down where they're not competitive and profit declining as a result. The only place people are making money is finance or in some sectors of high tech, but those sectors don't do you much good. The iPod is making a lot of money for Apple. It's just not made here. And that's true of a lot of other things. But there are other people. Yeah. Kind of things make sense to the extent to which people who are hurting begin to demand these changes. And as this crisis goes on, and it will go on, and as more people lose their jobs, and as services get cut because state and local governments relying on property taxes are going to have a harder time, the federal government is going to have to come through with some of the things Michael's proposed, but only if there's pressure for them to do it. I talked to, going back to 1929, 1930, I talked to people who lived through the Depression in the 70s. I went around trying to interview people. And one of the things that surprised me, although maybe not some of you older folks, even older than I am, that they said, well, nothing really happened in the first few years of the Depression. People were just in such shock that organizing was really difficult to impossible. And I think that that's sort of what you go through. If this stays bad for a few years, as I think it will, you're going to begin to get support for some crazy things, but also some sensible things. And it will push, if it's an Obama presidency, if there's pressure, it will move some of these ideas, which are good ideas, but which now are politically not feasible. They will become increasingly, or at least that's the hope. And this is will, all of it, I think. Well, some of it is going to go to the actual banks. He's given 250, I think it is, to the largest 350 to the largest 9 banks.
It's going to go to the hedge funds.
No, it's going actually to the large commercial banks. And Joe Nocera had a very interesting thing in the Times, which conference calls, where it was made clear that they damn well weren't going to lend out any of that money. They were going to keep it as a cushion because things are getting worse. And I think what we're going to see is this is going to keep getting bigger and bigger, and none of these things are going to work.
My question was, it's not going to go to the hedge funds, it's going to go to the private ends.
There's going to be a big fight for who gets it. They're all lined up in Washington. The auto companies, the insurance companies. It won't go to the civs. The civs But the reason it's going to the commercial banks is that the commercial banks gave backup financing to the SIVs. So all the special investment vehicles, the ones that were buying all the collateralized debt obligations and now have basically
They
worthless.
were uncontrolled and doing it without any formal.
Yes, the reason they were set up is that they are not banks, so they're not regulated. So it's off the balance sheet of the bank. They can do as they want. They don't have to keep collateral against and so on. And that's why Japan did the same thing. The commercial banks set up real estate outfits that gave mortgages. They all do this because as soon as a government regulates, it limits profit. The whole reason they regulate is to limit risk. To limit risk means to limit profit. You can't take certain gambles. You cannot gamble with basically our economy. We don't want that. That's why we regulate you. Your function is to keep money flowing through in a healthy way. That's why there's regulation. The banks, of course, don't like that. And so over the last 30 years, they've self-deregulated to the maximum extent. They've gotten Congress to but there's still some regulation. And so to get around that, they set up these other vehicles that I described. Territorial United States, the territorial United States is, and people who live in it, 80% of the people who live in it, are in trouble. That the security they once had, the retirement they once had, the opportunity for their children they once had, for 80%, that's disappearing or it's diminishing very substantially. U.S. capital, on the other hand, is globalized. And so they're all over the world. And they're doing very nicely, thank you. I mean, with some exceptions, and some important exceptions. So, I'm sorry? Well, now there's problems everywhere, including for them. But the stronger ones are buying up the weaker ones. The banks, you're getting at the turn of the century, Jerry was talking about how finance capital reorganized American capitalism from a very competitive form. It was destructively competitive. There was too much being produced of everything. And so you got U.S. Steel bringing together 90 separate steel companies under, Judge Gary would bring them all together and explain what prices are going to be. Standard Oil would drive out the independents. So we got a very few large oil companies, a few large steel companies, a few large auto companies instead of the huge number of auto companies we had. So finance capital restructured into an oligopolistic form. You're now seeing this globally.